Hey everyone, and welcome back for another deep dive. Today we're going to be tackling a pretty fascinating topic, global currencies.
Yeah. Exchange rates, all that good stuff.
And we've got this really interesting research paper. It digs into some surprising trends that, honestly, when I first started reading it, kind of blew my mind.
It's really fascinating stuff.
Yeah. Now, I know what you might be thinking,
Currencies.
right? Exchange rates. Sounds a little dry, right?
Maybe a bit.
But stick with us because this stuff actually impacts everyone. Like, think about it. Planning a vacation abroad. How far your money goes is tied to global currency dynamics. Or even that new phone you just got the price you paid is linked to this stuff.
Absolutely. It's more connected to our daily lives than most people realize.
For sure. And one of the things that really jumped out at me from this research paper was this idea, and it's kind of a mind-blowing one, even with all the talk about, a multipolar world and things like that, the U.S. dollar's grip on the global financial system. It's arguably stronger now than it was decades ago, like during the Bretton Woods system.
Yeah, it's fascinating, isn't it? It seems counterintuitive, but the dollar's influence is undeniable.
Absolutely. So let's break this down a bit. The research paper keeps referring to the dollar as an anchor currency. What does that even mean?
So an anchor currency is essentially a bedrock. It's like the foundation of the global financial system.
Okay,
It's a currency that other countries will peg their own currencies to for stability, right?
got it.
You can kind of think of it like a ship anchoring in a safe harbor during a storm.
Okay, that makes sense. So it's about providing stability and predictability. But why is the U.S. dollar the anchor? Like, what makes it so special?
Well, for one thing, just the sheer volume of trade. So much global trade is done in US dollars, and that creates what we call network effects.
Oh, interesting. Okay.
So the more countries and businesses that are using the dollar for those international transactions, well, the more convenient, the more efficient it becomes for everyone else to kind of jump on that bandwagon. It's almost like a giant snowball rolling downhill, gathering more and more snow.
So the dollar's dominance, it kind of feeds on itself.
Exactly. And it goes beyond just trade, too. The US dollar is also widely used for debt, especially in developing countries.
Okay.
And so that means that when those countries need to repay their debts, they need dollars to do that. So again, it further strengthens that demand for the currency.
It's like this massive cycle, just constantly reinforcing the dollar's position.
Precisely. And then, of course, we can't forget about safe assets.
Right, right.
So, in times of global uncertainty, financial turmoil, whatever it might be, investors, they tend to flock to assets that they perceive as, well, safe,
Right. Makes sense.
stable. And so what's considered one of the safest assets in the world?
I'm guessing you're going to say U.S. Treasury bonds.
You got it. So when the world gets a little bit wobbly, everyone runs to the US dollar for safety.
It's interesting. So that demand for those U.S. Treasury bonds, it drives up their price, which then strengthens the dollar.
It's this fascinating feedback loop, and it gives the US, well, an incredible amount of leverage in the global financial system.
It almost sounds like an economic superpower. But okay, so we're talking about anchor currencies. What about the euro?
Oh, yeah.
Europe has a huge economy, so surely the euro must be a major player in all of this, right?
Oh, absolutely. The euro covers something like 30% of global GDP, primarily concentrated in Europe, of course. And yeah, it emerged, as a strong contender to the dollar, especially in those early 2000s.
Yeah.
But it seems like its rise has plateaued a bit in recent years.
So why is that? You'd think with the economic might of the entire eurozone, the euro would be, at least giving the dollars a run for its money.
Yeah, well, I think there are a couple of factors at play. One is just the perception of political instability
Hmm.
within the Eurozone, right? So whenever there's a crisis or uncertainty within that bloc, it tends to shake investor confidence in the euro.
Makes sense. A currency is only as strong as the entity or the faith that people have in the entity that backs it.
Absolutely. And remember, the euro is a relatively young currency compared to the US dollar. It hasn't fully established itself as, this truly global currency in the same way that the dollar has.
Okay, so a lack of trust and kind of a shorter track record. They're holding the euro back a bit. But what about China? I mean, they have a massive and rapidly growing economy. Where does their currency, the renminbi, fit into all of this?
That's the question that a lot of people are asking these days. Despite China's economic might, the renminbi is not a major anchor currency yet.
Okay.
And there's a key reason for that. Its value is still really closely managed and tied to the US dollar.
So it's almost like the renminbi is stuck in the dollar's shadow.
In a way, yeah, it's difficult to separate, the renminbi's influence from the dollars because they're so closely linked.
Okay.
China has taken some steps to internationalize the renminbi, but it still has a long way to go before it can truly challenge the dollar's dominance, I think.
So is it even possible for the renminbi to break free and become a major player on the global stage? Or is it destined to always play second fiddle to the dollar?
That's a great question. And honestly, experts are debating this fiercely.
I bet.
Some believe that the renminbi's rise is inevitable, right? Just given China's economic trajectory. Others are more skeptical. They argue that, China's tight control over its currency, its financial system, that'll ultimately hinder its global aspirations.
So a bit of a wait-and-see situation with China. But this whole idea of a currency being pegged to another currency, how does that actually work in practice? Like, what does it mean to peg a currency?
So imagine a country, and they want to make sure that their currency remains stable against, let's say, the US dollar, right?
Right.
They could peg their currency to the dollar. And that means they're committing to maintaining a fixed exchange rate between their currency and the dollar.
Okay, so it's like creating this fixed link between those two currencies.
Exactly.
But how do they maintain that fixed exchange rate?
That's where the central bank comes in.
Oh, okay.
The central bank of that country that's doing the pegging, they're going to intervene in the foreign exchange market.
Okay.
So if their currency starts to weaken against the dollar, they'll buy up their own currency, right, using their foreign currency reserves, and that'll prop up its value. Conversely, if their currency strengthens too much, they'll sell their currency, and that keeps it from, appreciating beyond that pegged rate.
So it's like this constant balancing act, like using reserves to keep the exchange rate in check.
Exactly. And this strategy is often used by countries that rely heavily on international trade
Yeah, that makes sense.
because it provides that stability and predictability for businesses engaged in those cross-border transactions.
Okay, that makes sense. But what about the countries that don't peg their currencies? What other options are out there?
Well, on the opposite end of the spectrum, you have what are called freely floating currencies.
Okay.
And these currencies are allowed to just fluctuate freely based on market forces, supply and demand. Think of it like a boat on the open ocean, rising and falling with the waves.
Gotcha. So it's a more hands-off approach, just letting the market determine the currency's value.
Precisely. But here's where it gets interesting.
Okay.
Despite all the talk about a shift towards free-floating currencies, more liberalization, our research actually reveals a surprising trend.
Is that?
A majority of countries are actually moving away from freely floating exchange rates and towards some form of managed or less flexible system.
Wait, really? I thought the trend was towards like more liberalization, more free-floating currencies?
Yeah, that's the common narrative, but the reality is a bit more nuanced.
Okay.
It turns out that a lot of countries are finding those freely floating currencies, well, they can lead to volatility,
Yeah.
uncertainty, right? Especially in emerging markets. And they're realizing that a bit more control can actually be beneficial.
So it's about finding that sweet spot, that balance between flexibility and stability. But why would countries want to limit the flexibility of their currencies? Wouldn't that make their economies, less adaptable?
Well, a few reasons. One is that it can provide stability for trade.
Mm-hmm.
Predictable exchange rates that makes it easier for businesses to plan, to execute international transactions. It reduces the risk of those sudden price swings that could eat into their profits.
Okay, so it's like a safety net for businesses engaged in international trade.
Exactly. And then there's the issue of inflation. Some countries will use their exchange rate as a tool to control inflation.
Okay.
So a less flexible exchange rate regime, well, that gives them more control over those price levels within their own economy.
So it's like a lever they can pull to influence prices. This is fascinating how interconnected all of this is. Currencies, trade, inflation, central bank policies. It's like this giant puzzle where all the pieces fit together.
It really is, and it's this interconnectedness that makes the global financial system both fascinating and, let's be honest, pretty complex.
Now, before we go any further, I think we need to talk about something called the impossible trinity.
Yes.
It's mentioned throughout this research paper, so I think it's important to explain to our listeners.
Absolutely. The impossible trinity, or sometimes it's called the trilemma, is this fundamental concept in international economics, and it basically says that countries can't have it all
Oh, okay.
when it comes to managing their currencies and their economies.
That sounds ominous. What does it mean?
It means that a country cannot simultaneously have open capital markets, a fixed exchange rate, and independent monetary policy.
Okay.
They have to choose 2 out of 3. It's like a 3-legged stool. You can only have 2 legs on the ground at any given time.
Got it. So it's a trade-off triangle. You can pick 2 sides, but you can't have all 3.
Precisely. And this has huge implications for how countries, manage their economies. For example, let's say a country wants to maintain a fixed exchange rate and also have open capital markets, right? They're going to have to sacrifice independent monetary policy. Their interest rates will essentially be dictated by the country to which their currency is pegged.
Yeah, that makes sense. If you're trying to keep your currency stable against another currency, you can't also be setting your own interest rates, willy-nilly.
Right. And this brings us to another interesting aspect of the research paper, this massive surge in reserve accumulation by emerging markets, especially since the early 2000s.
So countries are stockpiling reserves like they're preparing for some kind of financial war.
In a way, yeah, they're building up their foreign currency reserves, particularly US dollars, to help manage their currencies, their economies, in a world where capital flows can be, increasingly volatile.
So they're creating a buffer to protect themselves from those sudden shocks.
Exactly. And this ties back to the impossible trinity. With that decline in capital controls and that desire for exchange rate stability, a lot of emerging markets have opted to accumulate reserves as a way to, maintain some level of control.
So it's a way to navigate that trilemma, right? They're choosing exchange rate stability and open capital markets, which means they need those reserves to kind of manage their currencies.
Precisely. And this leads us to another important concept. The research paper touches on something called the Triffin dilemma.
Oh, okay, this is getting complex. What's the Triffin dilemma all about?
The Triffin dilemma, named after the economist Robert Triffin, highlights the inherent risks associated with having a single dominant reserve currency.
You mean like the US dollar?
Exactly. And the dilemma argues that if the world relies too heavily on one currency for, reserves, stability, it creates this situation where that issuing country, the country of that currency, they're constantly under pressure to supply more of it.
Okay.
To meet that global demand. But supplying too much of your own currency can eventually lead to instability and, undermine confidence in that currency.
So it's a bit of a paradox. Countries want to hold these, safe assets like US dollars, but if everyone's piling into that same asset, it could actually create vulnerabilities in the global financial system.
That's the crux of the Triffin dilemma, and it's something that economists, policymakers are grappling with, especially as we navigate this era of interconnectedness and these evolving global financial dynamics.
It's like this delicate balancing act, right? A country has to juggle its own economic needs with the demands of this global financial system. But let's zoom out a bit. If the Triffin dilemma points to these potential risks of relying too heavily on the US dollar, what does that mean for the future? Like, what does the future hold for this whole global currency landscape?
Well, that is the million-dollar question, isn't it? And there's no easy answer. One possibility, though, is that we see a shift, right? We move away from this single dominant currency and towards a more multipolar system.
Okay. So instead of one dominant currency, like the US dollar kind of calling all the shots, we might have a handful of major players, all vying for influence. Almost like, I don't know, a currency version of the G7 or something.
Exactly. We could see regional currency blocks emerge, with the euro, the renminbi, maybe even other currencies like the Japanese yen playing a more prominent role.
So instead of one North Star guiding the global financial system, we might have a whole constellation of stars to navigate by. That's kind of exciting, but also maybe a little bit daunting. How would this multipolar system even work in practice?
It would definitely introduce more complexity, and at least in the short term, probably more volatility too. We'd likely see more competition among these different currencies. As countries and regions, try to establish their own spheres of influence.
Almost like a currency arms race.
It's possible, but, I also think we would see a lot of cooperation, a lot of coordination, because ultimately everyone benefits from a stable and functional global financial system.
Right, makes sense. No one wants to see the whole system collapse. But okay, if we're talking about potential contenders to the dollar, the renminbi seems like the most, I don't know, obvious candidate, just given China's economic power.
I agree. Renminbi definitely has the potential. I mean, it has the potential to become a major, major global currency, but there are still some pretty significant hurdles for China to overcome.
Like what?
Well, remember, we talked about this earlier, the renminbi is still tightly controlled by the Chinese government. They haven't really embraced the idea of a freely floating currency.
Right, they're still pulling the letters behind the scenes.
Exactly. And for the renminbi to really gain that widespread global acceptance, China would need to liberalize its financial markets further, allow for, greater convertibility of its currency.
So basically, loosen the reins a bit. Let market forces play a bigger role.
That's a big part of it. They also need to develop deeper, more liquid financial markets. Think of it like building a world-class airport. It's not just about the runways. You need those terminals. You need air traffic control. You need ground transportation. You need all that infrastructure that can handle a truly massive volume of traffic.
So China needs to build that financial infrastructure for the renminbi to really take off.
Exactly. It's a long-term project, but if they can pull it off, yeah, the renminbi could absolutely challenge the dollar's dominance in the future.
Okay, so let's say, hypothetically, the renminbi does rise to prominence. What would that mean for the average person? Would we all be walking around with yuan in our wallets?
Well, it's pretty unlikely that the renminbi would completely replace the dollar, right?
Okay.
It's more likely that we'll see a world with multiple major currencies.
Okay.
So you might find yourself using different currencies depending on, I don't know, where you are, what you're doing.
So like dollars for traveling to the US, euros for Europe, renminbi for China.
Exactly. And that could actually have some benefits.
Oh, interesting.
More competition among currencies could lead to lower transaction costs. We might even see more innovative financial products.
So it's not necessarily a bad thing to have this more diverse currency landscape?
Not at all. It could actually make the global financial system more resilient because if one currency were to falter, the others could help to cushion the blow.
Okay, so spreading the risk, as they say. But this brings us back to that point from the research table about those managed exchange rate systems, right? Even as capital controls have declined globally.
Right. It does seem counterintuitive,
Yeah.
but like we talked about, a lot of countries are finding that some level of exchange rate management is really necessary to maintain stability.
It's like they're trying to hold on to the steering wheel, even as the car is speeding up.
That's a great analogy, and it highlights the challenges that these policymakers face in a world where, capital is flowing freely and currencies can fluctuate so wildly.
So how do they even manage that balancing act? What tools do they have?
Well, central banks can intervene in those foreign exchange markets, like we discussed earlier. They can buy or sell their own currency to influence its value.
So it's like this constant tug of war with the market forces.
Exactly. And they can also adjust interest rates.
Right.
Higher interest rates, well, that can attract foreign capital, which in turn can strengthen a currency.
But higher interest rates can also slow down economic growth, right?
That's the trade-off. Policymakers always have to weigh those benefits of a stable currency against the potential costs to the economy.
It's a tough job. No wonder those central bankers always look so stressed out.
Well, they have a lot on their shoulders, that's for sure. They're responsible for navigating some of the most complex challenges in the global economy.
Now, I want to circle back to something you mentioned earlier about that potential for volatility and uncertainty in a multipolar currency system.
Right.
That's definitely a risk, especially during that transition period.
Absolutely.
What kind of volatility are we talking about here? I mean, could we see these wild swings in exchange rates that really disrupt businesses and economies?
It's possible. I mean, if countries and regions are really competing for, currency dominance, we could see those more aggressive interventions in the foreign exchange markets.
Right.
And yeah, that could lead to a lot more volatility.
So it's not just about which currency comes out on top. It's about how we manage that transition to a whole new system.
Absolutely. And that's where international cooperation and coordination become really crucial.
So instead of a currency war, we need like a currency peace treaty.
Something like that, yeah. We need some clear rules of the game and ways to resolve these disputes when they come up.
What about the role of institutions like the IMF, the International Monetary Fund?
Oh, the IMF could play a huge role. They could be providing guidance, monitoring exchange rate policies, acting as a lender of last resort if, a crisis hits.
So they're like the referee for this whole global currency game.
That's a good way to put it. But at the end of the day, the success of this kind of multipolar system really hinges on one thing: the willingness of these countries to cooperate, to find that common ground.
It's a reminder that, we're all in this together, whether we like it or not, and a stable, well-functioning global financial system, that benefits everyone. But let's bring this back down to earth for a second. For, the average person listening to this, what does all this talk about currency shifts and reserve accumulation actually mean for their lives?
It's a great question, and it's important to remember that these global financial dynamics, they have real-world consequences.
So it's not just this abstract theory.
Not at all. For example, the value of your currency, that can affect the price of imported goods, the costs of traveling abroad, even, the returns on your investments.
Okay, so if the dollar weakens, imported goods get more expensive, vacations abroad cost more, and our investments could take a hit.
That's the general idea. Of course, there are many other factors involved, but exchange rate do have this direct impact on our wallets.
So paying attention to these trends isn't just for, the finance geeks out there.
Definitely not. Understanding how the global currency system works can help you make more informed decisions about your finances, about your life.
Now, before we wrap up, I want to touch on one more thing from the research paper, this massive surge in reserve accumulation by those emerging markets.
Right.
It's a trend that's been building for decades, and it's got some economists a little bit worried.
Yeah, for sure.
Why is that? Isn't it a good thing for countries to have more reserves? I mean, more is better, right?
Well, it depends. It depends on how those reserves are managed and what they're being used for.
Okay, so it's not just about the quantity of reserves, but the quality. and the purpose behind them.
Exactly. And some economists argue that the current level of reserve accumulation, it's excessive, potentially even destabilizing.
How so?
Well, think about it this way. If countries are just hoarding reserves, right? Instead of investing them productively, it can actually drag down global economic growth.
So it's like money sitting under a mattress instead of being put to work.
That's a great analogy. And there's also a risk that these large reserve holdings could become a target for speculators.
Hmm.
People who might try to profit from those fluctuations in exchange rates.
So it's like this giant pot of honey that's attracting, financial flies.
You could say that, and if a country's currency comes under attack, they might be forced to sell off some of those reserves to defend it,
Okay.
which could then further destabilize the global financial system.
So it's a bit of a catch-22, right? Countries want to accumulate these reserves for safety, but those reserves themselves could become a source of risk.
Precisely. It's a complex issue, and honestly, there are no easy solutions.
Okay, so we've got this massive pool of reserves sloshing around the global financial system and a potential shift towards, this multipolar currency order on the horizon. What does it all mean? Where do we even go from here?
Well, that's the question everyone's asking, and the answer is, honestly, we're still figuring it out.
So we're in uncharted waters.
In a way, yeah. But it's an exciting time too, right? We're witnessing a pretty fundamental reshaping of the global financial system, and the outcome is far from certain.
It really does feel like we're at this crossroads, right? Multiple paths ahead of us. What are some of the key factors that you think are going to shape the future of, global currencies?
That's a great question. I think there are several trends to keep an eye on.
Okay, let's hear them.
Well, one is just the continued rise of those emerging markets.
Right.
Countries like China, India, Brazil, they're playing a bigger and bigger role in the global economy.
Yeah?
And it stands to reason that their currencies are going to gain more prominence too.
So we could see like a power shift from west to east.
It's definitely possible. And in a lot of ways, that shift is already happening.
What else should we be watching?
Another key trend is technology. I mean, the rapid pace of technological innovation, especially in the financial sector.
Right. Cryptocurrencies, blockchain technology, all these new digital payment platforms. It's like it's all happening so fast.
Exactly. And these technologies, they really do have the potential to disrupt the traditional currency system. I mean, in some pretty profound ways.
Could we even see a world like down the road where cryptocurrencies they replace those fiat currencies like the dollar, the euro?
It's a possibility, but it's hard to say for sure. I think it's still very early days.
So another wait and see.
Yeah, pretty much. But it's definitely a space to watch closely.
Now let's go back to the research paper for a second. They highlight this tension between the desire for exchange rate stability, on the one hand, and this trend towards declining capital controls on the other. How do you think that tension's going to play out going forward?
It's a tough one, right? Because countries want to attract foreign investment. They want to make it easier to trade.
Right.
And that often requires, having more open capital markets.
But they also want to be able to control their currencies, at least to some extent, to avoid too much volatility.
Exactly. And finding that balance, that's going to be a key challenge for policymakers.
Yeah, no easy answers, it sounds like.
I don't think so. It's going to require a lot of careful consideration and coordination among these different countries.
Now let's zoom out even further, like really big picture stuff here. What are some of maybe the biggest risks and opportunities that are out there for the global currency system?
Well, I think one of the biggest risks is just a loss of confidence in the system as a whole. If people lose faith in, the US dollar or the euro or other major currencies, it could trigger a pretty serious financial crisis.
So it's like a house of cards. Everything kind of depends on trust and stability.
That's a good way to put it. And if that trust erodes, the consequences could be really, really severe.
Okay, that's the risk side of things. But what about the flip side? What are some of the opportunities?
I think there's a huge opportunity to create a more inclusive system, a more equitable global financial system, one that benefits more people and reduces that gap between the haves and the have-nots.
So it's not just about like managing currencies for the sake of managing currencies, right? It's about actually using this financial system as a tool to create a better world.
Exactly. And I think that's something we should all be working towards.
Well said. This has been a truly fascinating deep dive into this whole world of global currencies. We've covered so much from, the dollar's enduring power to the potential rise of the renminbi and those challenges of managing exchange rates in this, increasingly interconnected world that we live in.
It's been a pleasure.
Likewise. And for our listeners, we hope this deep dive has shed some light on this incredibly complex but crucial topic.
Yeah, because like we've seen, the choices we make about, currencies, exchange rates, those choices have a big impact
They really do.
on our lives and on the world as a whole.
Absolutely. And on that note, we'll leave you to ponder the future of global currencies. Until next time, keep exploring, keep learning. This is The Deep Dive, signing out.